So here's what's happening. The stock market is in an intermediate degree correction, and coming out of the last intermediate cycle low, the banking stocks didn't really make a lot of headway. So the Fed is panicked right now, trying to prevent the banking stocks from coming down and breaking these lows and making lower lows. If they do that, we're going to have some more regional banks go under. So they are pumping lots and lots of liquidity into the markets, trying to stop the intermediate decline in the stock market, and most importantly, trying to stop the decline in the bank stocks and keep them above these lows. And so far, anyway, it's not going to hold much longer. But so far, all that liquidity, it is preventing the banks from breaking these lows, but it's leaking into other areas, and it's causing people to get overly bullish and excited about areas. But as I've said before, people tend to get really bullish, after weeks and weeks of the rally have already gone by, and then they end up buying at top. So let me show you where the liquidity is mostly going to right now anyway. All right, so here's oil. So for the most part, the liquidity has just been flowing into the energy sector. And, over the last couple of weeks, I've been seeing sentiment in energy has just gone through the roof. Everybody is, like they always are when we get close to, at least a short-term top. Again, I think oil is going to $200, $250, but there's going to be some corrections along the way. I mean, we had a correction here. We actually waited for this correction, and we bought right here. And we've ridden this all the way up, and I suggested taking profits yesterday when we hit this resistance zone. But because people now have the memory of this strong rally, they want to jump on now and expect that this is just going to continue indefinitely into the future. And small chance that might happen. I suspect we're going to have some kind of a correction here. From this resistance zone, we've got potentially a key reversal maybe occurring here today, but you're late. You're late to this move. Your best opportunity, of course, was right here, but that was kind of impossible to do because we had this choppy back and forth. This would have just eaten you alive, whipsawed you to death. So really no way to buy down here, just too erratic. So you kind of had to wait and make sure that we were, finally starting a trending move, and then buy the first dip. And here was that dip, and that's what we bought, and we've ridden this all the way up. Another area that people are now becoming, over the top bullish on, uranium. Again, kind of the same thing, just very erratic. And I warned people way back here that we'd had a big move and uranium was going to, be stuck in a sideways consolidation for many months, and that's exactly what's happened. It's been a year and a half, but now we're starting to trend again, and at some point we're going to break out above these highs and make another big leg up. But people are getting really bullish now, and it's you kind of missed the move. So instead of extrapolating that this is just going to continue going vertical for the foreseeable future, now's probably a good time to take some profits at this resistance zone. And that looks like kind of maybe what's happening. Now, maybe this goes through tomorrow and maybe it has further to go, but I would say that your risk reward is not great right now. The odds of this just continuing to go parabolic to the upside, maybe not so good. If you've ridden the move, maybe it's time to take some profits. And if you have missed the move, you might want to wait for a correction before you jump on board this. But this is where the liquidity has been going. So the Fed has been pumping billions and billions of dollars into the market to try and prop up the banks, and it's done it a little bit. It's kept the banks above those, whatever it was, May lows, March lows maybe. But most of the liquidity is kind of finding its way into the energy markets, and it's causing, near parabolic moves in those markets. But that's mature. So you probably want to now look for an area where maybe that liquidity is going to start taking profits in the energy sector, and look for something that's undervalued. And that's probably where the next parabolic move will come. So let me show you two areas. So the first one is the stock market. It's been in an intermediate decline. People are getting very bearish. I would have liked to see this continue down naturally and finish this. Well, we obviously got a plunge protection team rescue yesterday. The Fed doesn't want, if they get an all-out crash, they're not going to be able to support the banks. I think this would have bottomed naturally on this support zone here, which is right about at the 200-day moving average. It's also the 50% retracement. Comes in right at about 4,200, but I'm not sure we're going to get there. They may have been able to abort this just a little bit prematurely, but this is one area where the liquidity could now finally start flowing into the stock market as this ICL is mature. It's ready to bottom, and maybe the Fed managed to stop it a day or two early. So one area that this could flow back into again. I still don't like how far the stock indexes are stretched above the 200-week moving average, which probably means that even if stocks could come back up and retest these all-time highs, we're not going to get a sustained breakout above this during this 4-year cycle. So we're going to be stuck in this sideways churn for, I would think, another couple of years, because we're going to have a 4-year cycle low that's coming due next year. So once this ICL is done, which it may be, and we get our next intermediate rally, and maybe it comes up to this, tests it, maybe a marginal break. If we get a marginal break above this, you got to sell that and get out of the way, because we're going to have a move down into that 4-year cycle low. You got to avoid that. But this is going to be stuck for a while. And actually, let me put that 200-week moving average in there. All right, here's the 200-week moving average for the S&P. It's worse in the NASDAQ, where you can see we're still stretched way above that. And so I just don't think there's really much chance of getting a sustained breakout during this 4-year cycle with price still this far above that long-term 200-week moving average. So, we do have a multi-week rally ahead. I would think maybe through the end of the year, but then, in January, you got to probably be on the lookout for a top, and then probably the recession starts and we get a move down into that 4-year cycle low. Anyway, this is one area where the potential is there for the liquidity to start flowing into. The other area, of course, is metals. Gold has been stuck since May in a long intermediate degree correction. However, the correction has been one mostly in time. It hasn't really corrected all that much in price. So what we've got here is a really long multi-month, 5-month bull flag forming. Let me widen this chart just a bit. All right, so here was our move out of the 8-year cycle low. Very powerful, strong move. We came back up, tested these all-time highs, and now we've been forming this bull flag, but we haven't really corrected that much in price. We barely retraced back to the 38% Fibonacci level from this bottom. That is a very mild correction. But because it has taken so many months, everybody is getting, or has gotten, very bearish. They've become convinced that there's no way that metals can ever rally, even though the correction has actually been very mild. It's the same sentiment we saw down here, same sentiment we saw here. I've kind of gone over this in some of my tweets and stuff. It's the unsophisticated retail type traders, they become very recency bias infects them very strongly, and because metals haven't done anything for 5 months and they've just been a frustrating mess, they just assume that it can never go up. Just, and it's the same people that were doing the same thing down here. Metals can never go up. They can never go back up. Metals are dead. You're never going to make any money in the metal stocks or the metal trade. So same sentiment, but a different path to get there. These corrections were very severe in price. This one, the correction has occurred over time. So just too many months have passed with frustration after frustration. And so we've produced the same bearish sentiment, but we've done it by going sideways rather than, a huge correction back down. But this is another area where the liquidity it could be set up, and I think it will be set up to produce a big move. And these long basing patterns produce the biggest move. So while stocks may be able to test the all-time highs, when this correction consolidation is done, gold's going to break out above these all-time highs. Remember, the CRB is now in the advancing phase of a new 3-year cycle. All right, so here was the bottom of the bear market. Oil went to -35. Commodities are now in a new secular bull market. Here was our first leg up. Then, we get this long chopping correction into the 3-year cycle low right here. Now we're in the advancing phase of a new 3-year cycle. That's not going to leave gold out. Gold is going to participate in this, just like energy and everything else. And so while the move in energy is very mature and has reached some resistance zones, gold is still in its long correction and due to bottom. So the liquidity has potentially two places to go. Stocks, which could test the all-time highs but have virtually zero chance of producing a sustained move, and metals, which have a very good chance of not only testing those all-time highs but breaking out above those all-time highs, for the simple reason that commodities are now in the advancing phase of the next 3-year cycle in an ongoing secular bull market. So you have two possibilities, and I would probably put some money in both. Some in stocks once we get the bottom, and it looks like the Fed may have stopped it a little bit early yesterday, but also metals, which if they didn't, if they aren't bottoming today or tomorrow, they're close enough. So you could have been a little early, maybe got in here and had to weather another dip down, but obviously this was close enough. Huge move coming. Same thing. You're close enough at this point. We've got a huge move coming that's going to break out above these all-time highs, and we're probably going to somewhere between 2,200 and 2,300 before the next intermediate decline, and I expect the next one's going to be much shorter, but probably steeper decline in price, but much shorter than this thing here. So maybe this is the exact bottom. Doesn't matter. It's close enough. And when the advancing phase gets started in earnest, we've got a long ways to go up. So you don't have to catch the exact bottom here. You just got to get close enough.